on the effects of COVID-19 on our equity market outlook. A kind reminder to all participants to mute your microphones during the presentation. And also the presentation will be followed by a question and answer session in which you can raise your questions by unmuting the microphone or send in the questions through the chat option that is available, that is indicated in the bottom of your screen. And now I invite the head of research of John Keells Stockbrokers, Mr. Naveen Ratnayaka, to commence proceedings.
Thank you, Dishan. Just to give people an idea of the structure of this presentation, I will initially be talking about the macroeconomic effects of the coronavirus epidemic in Sri Lanka, and then sort of move on to the changes we've made to our earnings estimates from the last update that we gave, which was in February, to our coverage universe. Just to give a brief background about our team, I am the head of research of John Keells Stockbrokers. My prime area of coverage are with the diversified and banking segments. Gautam Gunasekaran assists me with the banking segments, as well as he covers the finance, insurance, as well as the real estate segments. Dishan Leo covers manufacturing, F&B, and he also assists me with the diversified segment coverage, especially with companies like Hemas. And Chirantaka assists me with coverage of the conglomerates. In particular, he covers Haley's, SoftLogic, and 8 Spence. He also covers the tourism and leisure segment, which is an important segment affected by the coronavirus epidemic. Just to sort of give a background as to what we think is going to be the effect, it is the variance between estimates is quite high. Recently, over the last 2 weeks, we've seen developed markets recover much faster than expected, largely because you've seen the prevalence of new rates of increase of infections, as well as the rates of increase in hospitalized and deaths related to the coronavirus start coming down. Having said that, the IMF recently, just 2 days ago, released their estimates on what they expect global GDP to be, and they've been projecting the worst recession since the Great Depression, where it would affect the full gamut of developed, emerging, frontier, basically the entire range of world economies. Our expectation is really that it is the poorer countries and the poorer segments of the economy that will be affected in particular. You would have had a lot of conversation about the impacts on daily wage earners, which come to almost as much as a third of our 11 million workforce. Even though Sri Lanka has dealt with the coronavirus epidemic with a fair degree of success compared to its peers, we feel that the shutdown and the effects of the shutdown for the next 12 to 18 months will be very strongly felt in all segments of the economy, not just the much discussed impact on segments like tourism or exports. We expect a negative GDP for Sri Lanka, a situation that only happened previously in 1999. We've seen equities come down sharply. Our year and a half high for the all-share index was 6,200. We've seen the market come all the way down to 5,400, which is a post-war low. The low in the bear market of 2012 has been surpassed now, and we also, however, still feel that especially dividend. We are not necessarily saying that these companies will pay dividends in 2020, but certainly their business models have shown that they're free cash flow generative. And a lot of these businesses have strong moats against competition, and are in the F&B sector, largely not as affected as many of the other segments of the economy. Later on, we've got some earnings estimates for a large portion of our coverage universe, which will cover the banking and diversified segments. And we'll talk you through those earnings estimates as well. To sort of give you a breakdown about how the pandemic has affected Sri Lanka, as you can see, we haven't seen the exponential growth that other countries have seen. Our situation appears to be largely under control, although there have been an uptick in cases from the quarantined segment that has been seen in the last few days. We feel the biggest positive here has been the fact that Sri Lanka shut down considerably early compared to global peers. One thing we have to mention is that epidemics generally tend to have second waves. There is some thinking that the coronavirus will have sensitivity to the cold, so it is possible that the winter season of 2020 could see a resumption in a second wave. Certainly also, while there has been a herd immunity theory for many of these economies, there seems to be some doubt as to what the resistance level to this disease will be. And also, despite the much touted potential of a vaccine, the mass production and distribution of a vaccine appears to be at least 12 months, maybe 18 months away as well. Having said that, we think that one of the positives on the mitigation side will be the availability of cheap and fast and accurate testing, which to a large degree should lead to economies coming back online, and certainly for international travel and trade to resume. We feel that hopefully, I mean, in South Korea already they talk about tests that will take 10 minutes or less, and cheap tests that can be distributed. Sri Lanka has also received new supplies of testing equipment, which has what led to the increase in testing as well. And we think that in the next quarter we should see improved testing, which should lead to mitigation of the economic impacts. While Sri Lanka will have a benefit from the reduction in oil prices, which don't seem to have reacted positively to the OPEC cuts that were mandated last week, we think that Sri Lanka should net have at least an $800 to $1 billion positive impact from that. We also feel that imports will reduce by about 35 to 40% over 2020, but textiles and garments will probably see again a 35 to 40% decrease, and obviously earnings from tourism will be greatly impacted depending on how tourism resumption happens over the next 12 months. At the moment, it is a zero revenue earning segment. Remittances will probably also be affected. As you can see, over the last 5 years, remittances have been basically flat, and we'll probably see something in the range of a 10% decline because most of these workers are in the Middle East, as everybody knows. On the capital account side, we will probably not see net foreign buying of domestic treasuries, but we feel that there should be positive impacts on a bilateral side. Just yesterday, I believe that there has been some acknowledgement by the G7 group of nations that bilateral financing terms should be relaxed for low-income countries. And certainly, there is a very good chance that Sri Lanka will go back to an IMF program, which is actually a positive in terms of improving confidence in our external financing situation. By and large, if you look at the tourism segment, we are very dependent on the developed economies. About 42-43%, as you can see from the table here, come from Europe and North America, which is the US and Canada. The fastest segment to recover will probably be the Chinese segment. But also, we certainly feel that the existing secular trend where you see the lowest spending segment and the highest spending segment will again be exacerbated by the impact of this epidemic. And while we feel that it might take a year to 2 years for tourism to come back to what it was, we certainly think that over time, tourism is also not something that leisure, global tourism is not an experience that can be replicated like something like through the internet and so on. So the impact of this crisis on the psychology of people, you could see a pent-up demand for people coming back to tourism destinations. Conversely, if the impact of the disease is more severe than people are expecting, you could see people staying at home and seeing international travel reduce substantially from these levels as well. So there's a lot of uncertainty as to what the future of the tourism leisure segment will be. Another thing that needs to be mentioned about tourism is that even though it is something in the range of $4.5 billion for Sri Lanka's $89 billion economy, the secondary impacts, especially on segments like travel, the informal sector, even F&B to a certain degree, are higher, and so those multiplier effects probably mean that this is a segment that comes to about 8-9% of GDP. So this will have a big impact on the economy. Just as a summary of what the government has done in terms of mitigating and providing a support net to the economy. The central bank announced a wide-ranging loan moratorium program, one that we feel will probably be extended past the date that they've given. Caps on interest rates have been proposed, a reduction in rates for working capital loans. If you look at a view to raising growth, the government had previously announced a reduction in the VAT rate, which is certainly something that will help the low-income segment of society as well. We'll probably see the government going for an employment generation scheme in the medium term to mitigate the impact on employment of the stoppage in the economy. And altogether, we feel that there will probably be a support scheme for SMEs that will probably be announced going forward as well. The fiscal situation is difficult to project for 2020, certainly with the reduction in VAT to 8%, as well as the higher government spending that is expected. We will probably see the deficit blow up to something in the range of 9 or 10% of GDP. Sri Lanka does have a lot of potential to catch up on the revenue side over the next few years. And one thing to keep in perspective is if you take the fiscal situation during the conflict period before 2008, Sri Lanka has been able to move past periods like this where government spending has been required to support the economy. And certainly the way this crisis has been framed is globally has been something in the range of an unprecedented event that would be worse than 2008. So while you will probably while the deficit numbers are bad, it is a situation where most of our peer nations in the frontier space and the emerging market space are in the same situation, and you will probably see the same sort of support that is extended to a lot of these nations to be extended to Sri Lanka as well. Interest rates have come down, but the demand for credit we don't think is price sensitive in this event. While we've seen rates come down substantially, you will probably see that gap between the prime lending rate and the risk-free rate reducing as well. But altogether, we feel that private demand for credit will reduce, but that space will probably be taken up by the government demand for credit. Generally, government issuance of domestic of treasuries has been in the range of about 450 billion or so. We will probably see that go up substantially over the next year or two. If you look at the outflow, the foreign outflow from treasuries, which has largely driven the depreciation, which I'm sure is a number you all keep tracking. We have probably come to the end of that outflow. Domestic treasuries, only 0.7% of the stock of domestic treasuries are now in foreign hands, and all in all, if you look at the net impact in terms of the outflow, the amount is actually minimal. Year to date, it comes to roughly about $380 million or so when you take treasuries as well as equities. Just going on to our estimates. So these estimates are basically something that we have taken into account that the economy should open up by May, June, and that certainly during the final quarter we will have at least 80 to 85% of the economy back up and running. And in that event, we estimate something in the range of a 30% fall in net earnings for the banking sector as a whole. These stocks, you might see this as overly positive, but really, when you look at the 20-year sort of range of earnings, especially for the major money center banks like Commercial and Hatton National and so on, they are basically quite resilient, and we feel that even though NPLs will probably spike from the current levels to maybe 8-9% or so, and provisioning will probably be higher, we will see earnings not dip to much more than 30% over the next year, and we will probably see some recovery by December 22. One thing that you have to keep in mind also is that even in the Western markets, there is some talk of the IFRS provision for the IFRS standard on provisioning be relaxed for these banks, considering the situation. That is a subject that is still under discussion, I think, amongst the regulators. And of course, the capital raising required by Basel III will stand these banks in good stead because of the additional cushion they have to mitigate loan losses. Certainly, we feel that banks like Commercial in particular and Hatton National Bank are essentially institutions that represent a large portion of the Sri Lankan economy. And when you look at a recovery period that will take 2 or 3 years from now, we think that these are stocks that are trading at generational lows. Certainly, we can't. The decline in the oil share is not something that will be easy to predict from a fundamental perspective, and we'd advise cautious collection of these counters, but certainly we think that these are price levels that you will not see 2-3 years down the line, considering the recovery from the epidemic. And if you look at their exposure, they've also got a very diversified exposure to the economy, which will help their recovery prospects more than certainly the smaller cap banks. F&B is probably the sector that is most resilient, like I said previously, and certainly out of these stocks, we feel that companies like distilleries, Ceylon Tobacco, and then Lion Breweries and Nestle's should have quite resilient earnings in comparison to the rest of the market. Ceylon Tobacco is a company where about 80% of their product are single stick cigarettes, and while these will be impacted by distribution issues during this period, we feel that going forward the demand for their product will be inelastic, and they should be able to maintain earnings going forward. Distilleries again has a regulatorily driven moat around their business, and we feel that again demand for their product will be inelastic. Lion Breweries does have some sensitivity to the tourism issue, but there again we feel that they should have some kind of resilience in terms of earnings. Nestle's in F&B terms, if you look at like their main products like Neste Malt, Maggi noodles and so on, would have had demand from the stockpiling effect of the closures. And again, going forward, we think that they should be worth collecting at these price levels, again, albeit on a cautious level. Diversified companies, here there is again great variance in what can be expected for their earnings. Obviously, almost all of these companies have exposure to leisure. Aitken Spence in particular, while they will have earnings from their power segment, will have probably a lot of weakness because even the alternate segment in the Maldives and so on will be greatly impacted by this. Haley's should benefit to a certain degree by their export orientation, but again, their investment in Singer and the weakness in consumer durable spending, as well as their weakness towards the depreciating currency, will be issues for their business model. Hema's had recently, I think, just announced wage cuts, as well as talked about the impact on their business, where they said basically the pharma segment is the only resilient segment for them. So there again, I think in terms of FMCG demand, we will probably see a lot of weakness for Hema's. Expolanca has had weak earnings during the 2020 financial year already, and they are greatly exposed to the vulnerable apparel sector, and we think that they will see losses over the next 2, maybe 3 years or so. SoftLogic, again, the impact from consumer durable spending as well as their vulnerability to the exchange rate will probably mean that they will make losses. And Dialog Axiata, while they do stand to benefit from the demand for digital services and from the stay-at-home effects of the quarantine, we are a little cautious on them because of the FX component of their borrowings, and a prolonged period of depreciation in the LKR will impact earnings at least for the next year. I would like Dishan to comment a little bit about the manufacturing sector. He has been able to speak to a few of the companies and his coverage. Dishan, would you like to say a few words?
Yes, thank you, Naveen. From the manufacturing sector, as you all know, one of the main segments that have got affected is the apparel sector, and the forecasts are that we are expected to lose. The apparel sector is expected to shrink by about 1.5 billion US dollars in the June quarter itself. And also with our conversations that we were able to have with some of the companies, very especially TJL, we understood that as of now, manufacturing has been halted due to the prevailing situation in the country. And also TJL has they've sort of held some of their orders that were supposed to be shipped to the clients for a period of 2 weeks. And also in line with the announcement that was made by Brandix, TJL also at a company level has focused on stringent cost reduction approaches, very especially elimination of non-essential capex and also elimination of other non-essential operating expenses as well. They've also been having ongoing discussions with suppliers regarding extensions in credit periods. And also at present, TJL is in discussion with health authorities of Sri Lanka regarding the supply of fabric for material of mass production in N95 mask. The contract is still being negotiated, so they didn't want to sort of disclose further into it. And also for the next couple of months, very especially in April, TJL expects 0 sales months for April and May. Even though they already have an order book of about 1.1 million US dollars for April. And also they've been able to maintain a very strong finance governance structure, which has been set up to make sure that the strong cash position that the company has is maintained. And also from the supply side, yarn supply from India and Vietnam also has been put on hold with the lockdowns that are seen in India, Sri Lanka, as well as some of the other regional countries. And also moving to another very important aspect during this current situation is dip products, which has actually been one of the very few companies that have been able to maintain business to a certain extent. And also from the 20th of March, DIP was able to gradually open up production. And also prior approvals for DIP has enabled them to carry out manufacturing in 2 plants at a capacity of about 50 to 60%. The company has not seen major disruptions and is focused on ramping up capacity and continuing business as usual. The industrial segment of DIP represents 30% of volumes, while household and medical segments represent 70%. The company has already received orders for about another 3 to 4 months. And also the company sees an uninterrupted supply chain with fully functional warehouses in Europe. The marketing arm, which is situated in Italy of DIP, has also seen a continuation in business with executives opting to work from home. And also the industrial segment, which consists of groups such as cleaning industries and security services, which also has been playing an important role in combating COVID-19, has also seen growth in demand. Therefore, the company is not seeing a major shift in the product mix in the short run. However, the surge in demand for protective equipment from countries such as Italy and also the European Union continues to indicate great opportunity in the short run. At present, there is a disruption from the supply side due to the current situation. However, the Export Development Board has granted approvals to start operations in the plantation sector. And also the main source markets for medical glove manufacturing, which is Thailand and Malaysia, which the company is yet to see any significant disruptions in the supply chain. And also going forward in the short run, the company expects to benefit from a possible price increase in some of its exports. And also the sharp depreciation of the LKR is supposed to further contribute to top line. However, we expect the uptick in operating expenditure to sort of create a threat in the short run due to the ramping up of production to meet increasing demand. And now I would like to invite Gautam Gunasekaran to share his comments on the insurance industry.
Thank you, Vishal. When it comes to insurance, premium collection has been pretty tough during the curfew time, and premium growth also has been pretty flat during the first quarter. To add to that, there's talks of similar to how banks and finance companies have moratoriums. Currently, there is talks of insurance also facing something similar. where policyholders might be given extension periods of up to 3 months for their premium payments from 1st of March to 30th June, while insurers will have to continue honoring all the claims. So this might have some cash flow issues for insurers. So that is something to be cautious about for the next quarter. So the insurers that are likely to do well are those that adapt quickly to online methods for premium collection and to sell policies. So developing the digital infrastructure will be crucial. When it comes to investment income, we're likely to see only modest growth this year given the current rate climate. Whereas when assuming COVID-19 goes down, CY21 will probably be a better year for all insurance companies. Thanks. On to Chiranta for leisure.
Yeah, thanks, Gautam. Yeah, like so how Naveen said, it's considering the nature of disruption that has been caused to the global travel, and also considering the nature of the virus, it's very hard to imagine any sort of recovery for the tourism industry this year. If you look at some numbers, so far for Q1, we had about 507,000 tourist arrivals, which is about a 32% drop compared to previous year. Assuming the health risk is contained within the country by the end of Q2, and we are in a position to open airports for inbound travel. So that will be start of Q3. I mean, you are still looking at about 500 to 600,000 tourist arrivals for the second half of the year. So at a best case scenario, you are only looking at about 1.2 million arrivals for the year. So which is about a 40% drop compared to the previous year's 1.9 million tourist arrivals. So it's very hard to say where we will end up at the end of the year. We need to keep in mind our key source countries as well, like India and United Kingdom. India accounted for about 20% of arrivals last year, and UK accounted for about 10% arrivals. So we need to keep an eye on how these countries sort of contain their virus spread. For a country like India, the risk of transmission is very high considering how dense the populations are. For counters like Spence and Keells hotels who have properties in Maldives, I mean, the World Bank has predicted it will be one of the hardest hit countries considering how dependent they are on tourism. The World Bank has predicted about negative GDP growth between 8 to 13%. Yeah, so like Naveen said, it's very hard to imagine any recovery for the tourism industry this year. And we can only expect tourism to resume and get back to its previous levels once the pandemic is completely eradicated. Until then, it's very hard to say there will be any recovery for the tourism industry. Disha?
Thanks, Chirantaka. Just to ask our participants whether they have any questions. You can either unmute your microphones and ask the questions, or you could perhaps use the chat facility as well. Okay, thank you. Just to give some perspective, I think on a sort of a technical note, if you look at, I previously said that our post-war low, I think in June 2012 for the oil share was 4,700, 4,737 to be precise. If you look at the track record for the oil share from 1985 onwards, the market has several times over the course of a year dipped by about 40% or so. I think in particular, if you look at the 1990s, it has happened twice, and certainly, I mean, 92, May 1992, March 1995, September 1998, which was the Asian crisis, December 2008, which was obviously just before the end of the Civil War, and June 2012, it dropped by about 35% or so. It doesn't, I mean, if you look at our year and a half high also of 6,200 for the oil share, if you are looking at the market dropping to that level, then we are looking at the market touching maybe the 4,030 level or so if it drops 35% from that 6,200 high. So this, I think it indicates that we are very close to a session to an intra-year low here, and the opportunity for cautious picking up of stocks, I think, is justified from that perspective as well. We're still open for questions if anybody has them.
Naveen?
Yeah.
Yeah, any indication where we are heading with the exchange rate?
I feel that we've seen some recovery actually in the last few days when we went from 200 to 195. I think I don't see it going much past the 210, 215 level. And certainly this is a problem that I think all non-US economies are having. If the dollar strengthens a lot more than this, then we will probably see, I think, some understanding amongst global central banks to suppress the effect for everybody as well. I mean, one worry that we have is that although the US market rebounded in the last few weeks, yesterday there has been a news flow that was not, I mean, apart from the effect on the Dow itself, the data that came out was worse than expected, and it's very possible that we will see worse than expected data coming out, because now I think earnings season has come for the US market as well, and the econ news flow is probably going to be worse than expected as well. So perhaps that might negate the flight to safety effects that has strengthened the dollar for everybody.
Okay.
There's been a question about leisure sector shares. Is it better to sell now and buy later in a year or so? I mean, like I said, from a technical analysis perspective, it feels that 4,000, that the market should stay above the 4,000 level. Certainly, I think selling now and buying back later might not make as much sense as sort of holding a position and waiting for a recovery. My perspective really is that you will see vastly improved testing before the end of 2020, and that you will see some recovery in leisure stocks, perhaps in the first quarter of 2021 or so. So, I mean, I would maybe, cautiously collect leisure stocks about 3 or 4 months down the line. There's another question as to why we predict a 30% drop in earnings for banks. I think the earnings drop shouldn't be much more than 30%, considering they are deemed an essential service, and so they've had a faster return to business. Two, I think you will see that the moratorium doesn't impact the collection of interest for them. And also, I feel that the large money center banks certainly should have some kind of benefit in terms of the exposure to the bigger cap corporates, which should mitigate the exposure to the SME and consumer segment. The banks tend to be quite resilient even in the face of very difficult times like this. There's another question asking whether I don't expect the SPI to go below 4,000. I certainly think that if it does go below 4,000, it won't stay there for very long. Finance companies, Gautam, would you like to give an update on finance companies? In particular, CDB and
CDB. Yeah, CDB will take a big hit because most of their portfolio is on leasing, and with the ban on importation in there, it's likely to have a slower year, if at all any growth during 2020. Whereas LFIN might still do okay, given that they have a larger loan book, gold loan portfolio. But overall, finance, also similar to banks, we expect about a 25-30% dip in earnings this year. Next.
Okay, then. So if there aren't any more questions, we'll wrap this up. Of course, if you have any questions that you would like to ask through email, my email address is navin@jkstock.keells.com, and we'll be more than happy to answer any questions that you have. This is the first in hopefully what will be a series of webinars that we would like to have, and we will keep you informed as to our upcoming program. And we hope that this finds you and your families well, and we will hope to speak to you again very soon. Thank you.